Hi everyone, welcome to the Buffett and Beyond Research, and today we're going over the ETF, which is the Nasdaq 100 QQQs. In other words, QQQ is the symbol for the Nasdaq 100, and we're looking at the big stocks on the block. Now, what does that mean? That means the stocks with the highest clean surplus return on equity, which means these are the stocks that are growing the fastest. And we also have an added bonus in hedging your IRA. And folks, we're up 78.8% this year to date. So we've been having a good year. Nasdaq 100 QQQs. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Now, let's look at the stocks with the highest return on equity. And folks, if you go to our website and sign up for our 2-week free subscription, you'll get the name of all these stocks as soon as you finish pushing that button. So we're looking at the highest clean surplus return on equity, and this is what they have returned this year. So we're looking at the QQQs, the Nasdaq 100, returning 41.5%, S&P up 14.5%, call it 15%. And the top stocks in the QQQs up a whole 78.8%. So if you're in an IRA, or if you just want to be hedged, because the QQQs can be volatile, folks, you go short the QQQs, but you are long these top stocks in there. And again, we'll get you those names as soon as you sign up for the free 2-week trial. So the difference between the top long stocks and the ETF itself, remember, you're short the ETF, you're long the top stocks, you would be ahead in a hedged portfolio 37.3%. Folks, that's twice as much as the S&P 500. That is pretty darn good, especially being hedged. So let's look at the stocks that were in the previous table, and this black line down here is the S&P 500, and we can see that just about every stock that we chose outperforms the S&P 500 and also the ETF itself. Now, which stocks are lagging down here? I'll tell you right now, you're not going to believe it. One is Amazon and one is Netflix. So yeah, those are the two that are doing just as well as the S&P 500, which means they're up almost 15%. But look at some of these other stocks that are just outperforming, such as Google, such as Nvidia, such as KLAC, such as Avago, or Broadcom, I should say. Avago is the stock symbol for it. So yeah, over 5 years, really good. Now, what have they done over 1 year? Again, the black line down here is the S&P 500. And right now, what's underperforming this year? Fortinet. And Fortinet is what? Cybersecurity. How can a cybersecurity stock underperform the S&P 500? I just don't get it, especially since it's been so good in the past. But anyway, all the other stocks are outperforming the S&P 500 this year. They are up, they're up 78.8%. So that's how well these stocks are doing. Now, how about hedging your IRA? Because you cannot go short in an IRA. So what do you have to do in order to hedge an IRA? You must buy an inverse ETF. So this is the QQQ up here, up over 30-some% for the past year. Now, what are these down here? These are your short hedges. Now, this is the SQQQ, which is double the QQQ to the downside. In other words, it's 2 times the inverse ETF. And this line down here is the BERZ, which is 3 times the ETF. Now, why do we want something like this? Because in your IRA, unfortunately, if you want to hedge, or hedge in this manner, what you do is buy something that's, say, triple the inverse ETF itself. So you're going to take about 1/3 of your money to buy this inverse ETF. You're not going short, you're going long, but it is an inverse ETF. Yeah, it can get complicated. And folks, I did not make this stuff up. And I did not make the rules. I wouldn't have made rules like this. And neither would you have. But anyway, about 1/3 of your money is in the inverse ETF, and the other 2/3 of your money are long the best stocks in here, which are right about up in here right now, 78.8%. So you would be short this and long that. Now, when your stocks go down, or when we have a correction in the market, this or either one of these will go up. while your long stocks go down. And that's your hedge. You're long the good stocks and you're short the ETF itself. And instead of shorting in your IRA or 401k where you can't short, you have to buy one of the inverse ETFs in order to be hedged. And folks, we are very good at that. We've been doing it for a long time, and our research goes back years and years and years. In fact, we have a 22 actual portfolio returns. So that's how long we have been doing things like this. So folks, we had a really good week this week, and you go out, you've done well. And if you're in that ETF, if you're in the top stocks, you're up 78.8%. And if you wanted to hedge, you're almost up 40% while being hedged in a normal account. So go out, have a good weekend, go for a walk, do some exercise, sit and watch TV, be with your family, be with your loved ones, get out there, clear your head, because guess what? We'll be back here on Monday. So folks, you stay safe. We'll see you next week.